All right. Good morning, everyone. Looks like we are live. And thank you so much, everyone, for joining us for today's webinar as we take a look at the latest MSCI South Africa Annual Green Property Index results. I am Annelisa Gege, Sustainability Professional, and I am your humble host for today's proceedings. We're joined this morning by Eileen Andrew, the Vice President of Client Coverage at MSCI South Africa, as well as a panel of industry experts, which include Georgina Smit, the Green Building Council of South Africa's Chief Executive Officer, and Engelbert Binedell, the Chief Operating Officer of Growthpoint Properties. Growthpoint Properties sponsors this index, investing in key research and hard data to drive the green building business case. As Growthpoint's representative is here today, I'd like to introduce Engelbert to formally open today's proceedings. So, Engelbert, I got to hit the bio. With over 2 decades of experience in the property industry, Engelbert is a seasoned executive recognized for his strategic vision and leadership. His career began as a teacher, where he developed a deep passion for people and their personal growth. He later joined the risk department at Investment Private Bank. His interest in real estate led him to Investec Property Group. He gained his MBL and managed a diverse portfolio of assets, including those owned by Growthpoint, Netboard, and Investec. Following Growthpoint's buyout from Investec, he has held several key leadership positions within the company, including head of asset management industrial. In his current role as Chief Operating Officer, he oversees the company's day-to-day operations, encompassing property management, leasing, information technology, legal, and training. Leading a team of over 400 professionals, Engelbert is dedicated to driving growth, innovation, and operational excellence within the property sector. Engelbert, over to you.
Thank you very much, Annelisa. That's a bit embarrassing in that introduction. Thought we were going to keep it brief, but it's a wonderful opportunity to be here today. And as sponsors of the MSCI Green Property Index, we're very proud to be associated with both MSCI and the Green Building Council of South Africa. But why do we do it? At Growthpoint, we integrate sustainability across everything that we do, from development to operations. And what the data has shown is that green buildings give us lower operating costs, better tenant experiences, and more resilient future fit assets. And it's also showing that the returns are there. What is changing and what makes this moment important is the market is catching up with the data, or what the data has been telling us over the years. And the real question is not whether sustainability creates value, it's how quickly we as an industry can scale it across our portfolios. And that is why platforms like the MSCI Green Index are so important. They provide the independent, data-driven insight that helps the industry move forward with confidence in the space. Thank you, Annalisa.
Thank you so much, Engelbert. And thank you to Growthpoint for sponsoring this research, which really does benefit the entire sector. So before I hand over to Eileen, just some rules for the audience. I'd like to encourage each of you to please leave comments and ask questions in the chat option provided. I will be happy to share these with our panel during the Q&A at the end of the webinar. And now I'm going to introduce Eileen Andrew, who is going to present the MSCI results. Eileen's role at MSCI provides her with a unique perspective of real estate investment strategy and portfolio optimization. Now, as the Vice President at MSCI, Eileen has experience working with both South African and multinational real estate funds, gathered from her 20 years with the MSCI, previously IPD, both in South Africa and London. She holds a degree in mathematics and human geography from Wits University. Eileen believes the numbers tell the real story, and that makes for better investment decisions. Eileen, over to you.
Thanks very much, Annalisa. All right, well, I'm going to jump straight in the conscious of time, and I'm going to talk you through the results. And they are a really great set of results to be able to talk through. Sorry, there we go. But first of all, thank you very much to GrowthPoint for sponsoring the index. Again, they've been sponsoring and been on board since we started this, and we started doing this 10 years ago. So it's fantastic that in this year, we'll be able to show you what 10-year annualized returns are. And the reason that that's super important is that we are not investing in property, or investors don't put money into property for a short-term quick gain. This is not an equity play. It's a long-term, slow sort of capital play that we take over. We took a long-term bet, and these results really do show us that that long-term bet in green certified properties is paying off. So thank you to GrowthPoints, and thank you to the GBCSA as well for hosting us today. Okay, so just talking a little bit to the composition. I'll come to that in a moment, showing you key takeaways. And really what I want to drive home is that green buildings, or this green index, is showing that it's all about risk reduction. How do we manage risk within the assets? And something that I'm going to end off is starting to talk about climate risk, which is something we are very much getting our heads around. It's quite new to us in the industry, something that we're probably grappling with for the last 4 or 5 years around. Although the concept of sustainability has been there for a long time, this idea of understanding climate risk is quite new. But it is something we're going to think about quite deeply and quite quickly. Okay, so talking to the results and how that plays into climate risk, first of all, is that green certified properties have achieved a higher total return over the last 10 years. When we look at a 10-year annualized return, they have delivered higher returns than non-green properties. In this last year, we did see that certified properties came up with a slightly higher return, but that really is just a reflection of a boost in the capital growth underwritten by rental growth that has started to catch up on the certified properties in this 1 year. So really, we're not going to hang our hats on just 2025. We need to think about this as a long-term income play, and the resilience that comes from these assets over longer term periods, because when we look at the rental and we look at the vacancies, and I'll show you all of these numbers, over that period of time, certified properties have provided a better income stream. If we look at, we're not just looking at offices, we are starting to look at retail as well. This is the second year that we can show you green certified retail assets versus non-retail assets. And those are starting to give us the same set of returns, a very similar kind of track record, delivering this longer term steady income stream. And then the last thing that I'm going to show you is we ran the numbers through the MSCI climate risk model, and there too, certified offices actually deliver a lower transition risk than what the non-certified offices are. And I'll explain what that means in detail. Okay, so here's all the high level numbers. I'm not going to talk to them. I'm going to show you the longer term trends, but I do just want to draw your attention to the boxes, excuse me, at the bottom of your screen, showing you the samples that we've looked at. In this year, we had 122 green certified offices versus 120 non-certified offices. And I should also stop to mention, when I'm going to probably use the word offices, we do specifically look at prime and A grade offices only. So there is a like for like comparison. We're not just looking at sort of prime and A grade in the certified versus B and C grade in the non-certified. That is not the case. We're looking at a like for like prime and A grade offices. In the retail, however, we're not splitting it out by center type, because the sample's a little bit small for that. We would like to ideally be able to do that, and maybe in the future we will. We've got 33 certified retail assets and 351 non-certified retail assets in the South African sample. All right, so let's look at prime, the office market first. And the reason that we do spend more time looking at this, because we've got this longer track record. That is where certification started. And so we've been able to provide those steady income stream comparisons over longer periods of time. So what you're looking at here is the total return number. The green bars across the presentation is certified, and the purple is the non-certified. And like I said, in this last year, we did see somewhat of an inversion where we saw certified giving us a slightly lower return than the non-certified, and I'll explain where that comes from. But if we go back through the history, you'll see with every single other year, non-certified has beaten the certified offices, even through that downward COVID period. We've seen that resilience come through in those certified certified offices. So when we talk about resilience, we may also be thinking about mitigation of risk. So how do we mitigate risk in the market? How do we reduce the impact that certain risks have on the portfolio, be that income stream or climate? And green certification is starting to show that it is a great risk mitigation tool. Okay, here we're looking at, excuse me, total return indexed over that period of time. So if we started at sort of at a base of 1 or at 100, where has the return grown faster? And here very clearly over 10 years, green certified offices have delivered a higher return than non-certified offices with about a 20% gap over that period of time. Again, looking at a longer 3 and 5 year. So we're looking at 3 years, 5 years in the middle, and 10 years on the right-hand side chart. In each of these periods of time, we see that the green certified delivers that higher return with a better capital growth. Now, the capital growth numbers are negative on all of them. You'll say, yes, offices we know have gone through a tremendous downturn in the last 10 years. We've seen a flight from capital from offices. We've seen a whole new work from home scenario. We've seen an oversupply of offices that were built through the sort of teens of 2015, 16, 17, 18. So a lot has happened in this space. We've seen a massive structural shift effectively at offices. So it's not surprising that the whole market has seen valuation decreasing effectively in 10 years. But the fact that green certified offices have seen less of a devaluation increase or decrease rather than to the non-certified offices, that's what we need to focus on, that resilience and the reduction of the risk factor within that. Okay. If we look at the income return number, I won't spend long looking at this. This is basically a yield. So the relationship between a value and the income, there you've seen that non-certified office kick up a little bit, and that's because of that good rental growth. It's coming off a lower base. I'll show you those numbers in a moment, but that's effectively what's driven that income return number to above the benchmark in this 1 year. But if we look through the history, it has generally been sort of tracked sideways, whereas the benchmark, we've seen a sort of consistent increase, and you see that coming through on the right. If we stop and we look at capital growth for a moment, consistently on the left-hand side chart shows you that that capital growth number for the certified offices has been above the non-certified offices, with the exception of this last year. Okay. The right-hand side chart, though, if we look at a 10-year indexed number, you see how the steady that green certified capital growth has been, the resilience has been in that number. So it hasn't seen the decline over the period of time or the loss of value over the period of time to the same extent that the non-certified offices. So if I explain that more in a simple term, a property that was worth 100 Rand in 2006, or if we take both properties worth 100 Rand in 2016, that green certified property is now worth sort of 85 Rand, whereas the non-certified property is worth 75 Rand. So granted, they have both lost value in 10 years because of the structural market shifts in offices, but the green certified offices have lost less value than the non-certified offices, i.e. the less risky of the two. Here we see that capital value per square meter, and there very clearly over time, you see that that capital value per square meter declining in that certified offices and has consistently been lower. So those certified offices have got higher values per square meter. That often translates into a cap rate number. So we think about those two things quite closely. The cap rates of the green certified offices tends to be lower and is consistently lower, even though there has been a little bit of movement in that number. And certainly there's been a big movement in that number. And I'm going to show you that movement in the next slide, but from 2016 through to 2025. If I just stop and answer, what is a cap rate? And we often have, this is probably the most talked about thing within the real estate market, is what is a cap rate? A cap rate is very simplistically a measure of risk. How much are you going to discount the cash flow of that asset over a period of time to give you a value? And the cap rate being lower for certified offices means that there is less, or the valuation community believes that there is less inherent risk in a certified office than what is in a non-certified office. And the risk in what? The risk in the income, the future income stream. So your income stream is effectively is more certain in your certified offices than they are in the non-certified offices. That's what your lower cap rate is telling us. Okay, the right-hand side chart shows you the spread between the green and the purple line. And while that spread did narrow for certain periods, we're starting to see that spread widen again. So the differential between those two risk factors is pulling away again. This is just to show you how much the cap rate has actually moved. Now, we have seen what we call cap rate or yield compression, or the other way around, over time. So we're just taking this sort of over the last 5 years, and cap rates have actually softened for green certified by 15 basis points, and they've softened by just over 20 basis points for non-certified. So your risk premium has increased over time because of the structural changes that have happened in offices, but they have done so less in your certified offices than in your non-certified offices. This is effectively why the risk is seen in the way it is by the market, is because your your net operating income that comes out of the assets for certified assets is substantially higher than it is for non-certified offices. If you look at the decline in that net operating income as we've gone through the structural shift in offices, it has declined more for non-certified offices than it has for offices. So offices have held the income stream that they produce much better, and that's what goes into the valuation numbers, and that's where the cap rate tends to be less. But that differential is substantial. We're looking at sort of 50 Rand a square meter difference between the two. Now, this is the number that drops out the bottom. It's not the actual rental number itself. It's after all the operating costs and the recoveries and everything else has been taken into account. Now I'm looking at the growth in that number on the left-hand side chart. So you can see that red portion in the middle where offices where it really took a lot of pain and their net income growth was really, really going backwards. We saw massive rental reversions. We saw vacancies increase in the market. And really it was a tenants market. So tenants were driving the prices, and we saw income come off. We have seen almost a correction in that, and we've seen good income growth in the certified offices, in the non-certified offices, sorry, more than in the certified, but it is because, and I'll go back one slide, they are coming off a lower base. So we are starting to see them picking up. So as the market's starting to recover, the office market has been more buoyant in the last sort of 12 to 18 months than what it was previously. Those low base offices are starting to pick up off of lower rental numbers, and that's what we see coming through, and that's what's driving the valuation growth in this last year only to be above the certified offices. It is not an indication of an improved risk or an improved overall return that comes through. We need to take the longer term view consistently. Again, if we look at rents per square meter, so let's take away the noise of operating costs and everything that gets recovered. Let's just purely look at the base rental. So it's that first line of your income statement. Certified offices, you can see the difference in those certified offices rent per square meter. And on the right-hand side, the growth is actually higher in the non-certified offices, again, because they're coming off a low base. So they are able to grow their rentals a little bit faster as they catch up with the certified offices. But that's not to say certified offices are not growing. Certified offices are growing at around 4%, which is ahead of inflation. These numbers are just really far beyond that as they come off a very low base. And all the reversions that happened prior to that. So we need to take the history into account as well. Here we want to look at vacancies. Vacancies are the key metric for us to understand tenant demand. What kind of spaces do tenants want to occupy? And We've seen the vacancies. Granted, there was a little bit of a restructure after COVID. There was a lot of noise in the market at that point. We had, we lived through it, working from home, going back to the office. Then we had load shedding. People were not occupying. They couldn't really work from home anymore, so they were forced back into the office. And things are starting to settle now in the last 2 years. And as that settling comes through, occupiers, so the actual tenants in the spaces, are understanding what kind of spaces they want. And that's really what's driving some of that office market coming through at the moment, along with better GDP growth, of course. And so we're starting to see the vacancies of these green certified offices much more consistently come off. So we're seeing that the take up from tenants is much better in the green certified office as we start to settle and things improve than what it is in the non-certified offices. Okay. We obviously can look under the hood, we can look at costs, and we unpack the whole income statement of costs. We collect every single cost line. I get asked this question very often: why are the operating costs higher for certified offices? It is because of rates and taxes. Because the value of those assets is higher, your rates and taxes is higher. Rates and taxes account for 30% of your cost bundle, and so they are going to drive these numbers up. There's no way around that unless we figure out municipal rates bills. And if anybody who has ideas around that, we'd all be very happy to hear it. But that is the reality of where the numbers are. If we start looking at some of the other smaller metrics, they're much more equitable, especially things around electricity. Now, I know that green buildings doesn't just hinge around electricity, but that is a very big part of your cost bill. Because of that, another 30% of your costs comes out of electricity. Okay, and that cost growth number, you can see they're growing a little bit faster at this point. There was a re-rating in rates actually in this last year, which drives that cost number. Okay, I think what's important when we start looking about costs is not so much the costs per square meter, it's your cost to income ratio, because we need to understand the relationship between the income that we earn and how much does it cost us to earn that income. And as long as our income is growing faster than our cost bundle, we're in a space that's kind of what we achieve, what we're wanting to be in. And here we're looking at quite a substantially lower cost to income ratio on the certified buildings than the non-certified buildings, and that is driven by the higher net income that we have in those assets ultimately. Yeah. I think what's also interesting is if you look at how these numbers are growing for your non-certified offices, whereas in your certified offices, they stayed quite static in the last sort of 2 years. This growth period here, and it's similar for both non-certified and certified offices, had a lot to do with the cost of services around diesel and load shedding that came through on the income statement as well. And that's been taken into control massively. And again, I come back to electricity through the recoveries of electricity on the income statement through solar. And we see that more so in the certified buildings than the non-certified buildings. Georgina will tell me that certification is not just around electricity, and I'm sure she's absolutely right, but we do see the electricity playing a big part in this kind of cost and income relationship. Okay. I'm going to talk to retail quickly because, and we'll leave these slides with you, other than to say that we're seeing that similar story start to come through in retail, where certified retail properties have got better returns than non-certified retail properties for the second year in a row now. We break that down into capital growth. It's the same thing that we do with offices. Everything mimicked, all the metrics mimicked in the same way are pointing in the right direction, where the certified offices, we're not getting any kind of conflicting story come through in retail. It's tracking in the same direction. Okay. I'll leave this all with you to look at in your own time, but you'll notice that the growth numbers for certified are higher. You'll notice that the vacancies are lower, most importantly, and you'll notice that the cost of income ratios are lower as well with those certified retail properties. Okay, I want to spend some time talking about climate risk, because I think this is a newish concept. It's certainly a new concept when you talk to property managers and guys, but this idea of climate risk is starting to permeate through all parts of the property sort of sphere, with all stakeholders starting to or needing to understand, how do we bring climate risk into our portfolio? How do we need to think about this? So We've done some, obviously, MSCI has a climate risk tool, because what we need to understand is, how does climate risk impact the return of the asset at the end of the day? How does it change, or does it in fact change the cap rate? How do we factor it in? Maybe it doesn't change the cap rate, maybe it's another way of factoring it in. And the way that we bring it in is through understanding physical risk. Physical risk has to do with the actual location, the absolute geolocation of that asset, and what physical risk that is exposed to. So things like floods and wildfires and so on. Transition risk talks about the property's decarbonization pathway. So how much emissions comes out of that building from the operations of that building, and is that being reduced over time? And then the third thing that I'm just introducing really is biodiversity and what we call nature risk. Is our properties exposed, or how are properties exposed to biodiversity? How are we affecting biodiversity in the asset itself? And how are we mitigating that risk? Okay, so let me explain the transition risk model before I can actually talk to the results. Effectively, and I think many of you on this call are going to understand climate scenarios more than I do, because this is probably more in your wheelhouse, but let me have a go. Effectively, what the climate risk scenario is doing is saying, what kind of pathway do you believe we are on in terms of getting to a 1-degree scenario, a 3-degree scenario, or there's many of them in between that as well. But we're going to talk really about a 3-degree scenario and a 1.5-degree scenario. The 3-degree scenario is, do we believe that we're looking at this? So in 2050, the temperature increase will be 3.5 degrees, or are we trying to hit a 1.5-degree scenario, which is a far more difficult target to reach? Okay, if we believe we're going to get to 3 degrees, this little piece of orange, if our building is emitting 80 tons of carbon at the moment, the straight line, and it continues to emit 80 tons of carbon into the future. So climate risk is forward looking. Okay. This is how much carbon I need to actually reduce by, okay, to get to a 3-degree scenario. If we believe we're going along a 1.5-degree pathway, this triangle here is how much carbon we believe we need to take out of our building. Now, there's no regulation that tells us which scenario or which pathway we need to follow. That is very much a corporate decision that investors or companies will take internally to sort of aligned with their own understanding of the world around them. What we do then is we take that amount of carbon and we say, well, let's times it by what we believe the carbon price to be. Now, again, this carbon price is arguable and it's built into each of these different models. And I'm sure we can debate, and I know that it gets debated ad infinitum, what the carbon price is, but we're going to use the same models to assess the data. So actually it becomes a bit of a moot point because we're using the same number throughout. And what that gives us is what we call a transition risk number. It says to us how much value, what would it cost in terms of value of the asset to take out this amount of carbon? Okay, how much value of the asset is at risk in 2050 in a current pricing? Because what we want to do is bring it into the current day's sort of value of that asset. Okay, so what we did was we took the whole South African universe. We collect data on about 1,800 assets across South Africa, and we pushed them through our model, and we said, right, what is if I chose a 1.5-degree scenario in South Africa, and I was really being quite excited about where I think we're going to get to in the world. What that effectively is telling us is that it will cost us 30% of the value of the current property value. Okay, so our index of that 1,800 assets sits at about 410 billion rand. It'll cost us 30% of that 410 billion rand to decarbonize those assets to get to a 1.5-degree scenario by 2050. So this triangle here will cost us over that period of time 30% of the value of the assets. Okay. Then I said, okay, well, that's quite high. Okay. If we took a different scenario and we looked at like a 3-degree scenario, we're looking at a much lower number. That number comes down to about 4 or 5%. So significantly different. Okay. So the scenario does matter. And it really is, like I said, dependent on where you believe we're going and what we should be doing in the market. Okay. Then we decided to test the same sort of climate risk metrics on our sample of certified versus non-certified officers. So we took the certified officers and we ran them through the model, and then we ran the non-certified officers through the model, and we looked at what are the transition risk results across the two different scenarios. So we've kept the scenario the same. So the carbon prices that are built into those scenarios are exactly the same, and we just want to have a basis, the variable that we want to take out a variable, so we want the same base comparison. Okay, so you'll see that first of all, that 1.5 degree scenario, it will cost for your green certified officers, similarly, 27% of the value of those officers in order to decarbonize in 2050. Again, a very sort of severe optimistic trajectory we're on there. On the same trajectory of non-certified officers, it would cost 36%. So through certification, what this effectively is telling us is that through certification, it is possible to lower your transition risk of your assets. Maybe in the short term, if we look at 2030, very little in it. 2040, it gets a little bit more. And then in 2050, that difference starts to get bigger and bigger. So over longer periods of time, that green certification does have a bigger impact on transition risk. If we look, though, at a much less robust scenario, so something like 3 degrees, you'll see that the transition risk, even in 2050, is much lower. So certification has a much lower impact on transition risk when we look at a much easier, let's call it that, scenario. Okay, so on the difficult scenarios of 1.5 degrees, it actually does have a big impact. Okay. So we could equally say that you're de-risking the portfolio on transition risk through certification, and then we're showing this through actual data. Okay. The other thing that I'll talk about just briefly is physical risk modeling. Here we take the vulnerability, so what hazard we're actually looking at. We then look at the location of that building, and we look at a cost function. So what might be lost if that building is exposed to flooding or very high precipitation, so rainfall, if there was business interruption and damage to the building itself. And we kind of look at that as a financial cost. So again, as a percentage of the building itself against different scenarios, because different scenarios mean that the intensity and the frequency of those physical events, those climate events, does change. Okay. And you'll see those physical risks are very, very broad. We've got everything from, we've got acute risks and chronic risks. So acute risks are things that happen most immediately. Chronic risks will happen continually over periods of time. They just become more and more. And everything from temperature related through to things maybe we don't experience in South Africa, like avalanches, but maybe something like subsidence we would see more occasionally. So not every physical risk is exposed to every location. So that location is incredibly important of that building, and that's what this becomes hinged on. Okay. One of the physical risks that in South Africa is extremely important is extreme heat. Now, already we say that we live in a hot country. How much hotter could it get? And that's what we start to look at. So I've just taken 3 snapshots here. The first graph you're looking at, or the first picture you're looking at, rather, map, is the current situation. So, and we measure that in number of days above 30 degrees. We could also look at this in number of days above 35 degrees, but that is considered too extreme. We actually want to look at it 30 degrees as the sort of recognized norm. And the orange is the amount of days above 30 degrees. Then we look at, and that's current, then we look at 2050, and we say, so how many more days are we going to get above 50 degrees, above 30 degrees in 2050? And you can see it gets more orange. Okay. Now, whether you can see that or not on this map, but I'm telling you it does get more orange. And then on the right-hand side map, it's the delta. So effectively, wherever it's red on that map, it's saying that we will get between current, right now, 2026 and 2050, so the next 24 years, we will get between 20 to 50 more days above 30 degrees. Okay, so if you take a property in Polokwane, it is very important to understand, if you're building for the future, that your air conditioning system is going to be under a lot more pressure going forward than what it is right now. So it will have to deal, yes, it will have to deal with a large number of days above 30 degrees where it's hot for your occupants, but it's going to have more hotter days, and so it's going to work even harder. That needs to be factored in. Yeah. So we can see that climate risk is very much real when we look at real data. This is looking at the actual MSCI portfolio, and those are the MSCI benchmark, and those are all the assets mapped. And I just took extreme heat and looking at the northern side of our country to demonstrate this. Okay. I then ran, just like I did in the transition risk, we ran the certified officers and the non-certified officers through the model and picked up on some of the risks. Now you can see the ones that do pop up with having some kind of risk is fluvial flooding, and extreme heat. Some of them are less important. The list is a lot longer. I just took a snapshot of the list. But effectively, there isn't a huge difference in physical risk between certified and non-certified officers. And that is because the modeling it doesn't build in physical characteristics of the building itself. There is a lot of talk about the modeling being advanced to be able to look at maybe flood defenses or HVAC systems. So actual mitigating barriers that are in the building, they aren't there yet. And so because of that, we don't see a difference in physical risk reduction through certification. Okay. And then this is my last slide. This is showing you how MSCI is starting to think about nature risk or biodiversity, let's call it that, and about where the assets are located, and the potential impact that asset could have on biodiversity lost. And these are just showing you 4 different regions of the world and how we think about biodiversity, and which areas are actually high risk areas because they're very high biodiverse areas and they're seen as protected or areas of concern, let's put it that way. And so this is part of the model, but it's a very important part of the model that we're starting to bring in. We're probably not quite there yet in this, but this is the track that we are starting to think about. And I say I don't just mean MSCI, I mean the world in general. When we're thinking about climate risk, we're sort of starting to get our heads around transition risk. We're far down the road on physical risk, and now we got to understand how our buildings impact biodiversity. I hope that I've been quite clear on all of that. And I think I'm going to hand over on that note back to Annalisa. And I think I've left us enough time to have a good, robust conversation. Let me also stop sharing my screen.
100%, Eileen. Thank you so much. And thanks for contextualizing, the index results to climate resilience, as well as taking us through the retail asset results, which also show that certified assets tend to outperform the benchmark. And just for the audience, I just want to draw your attention to the fact that the climate results that Eileen kind of took us through, especially with the scenario planning, that is typical of the type of climate risk modeling that is expected of companies under the IFRS S2 standard on climate-related disclosures. So this is definitely something that will probably keep coming up in the future. So let's move to the panel discussion. I've already introduced Eileen as well as Engelbert, but I've got to introduce the new GBCSA CEO. So Georgina Smith is an award-winning leader and driving force in sustainable design and green building innovation. She served as head of technical for the GBCSA for 5 years before assuming the CEO role in May 2026, i.e. 1 month ago. Georgina directs the GBCSA's strategic mandate to mobilize industry leaders, government partners, and the property sector toward a net zero future. Her passion for collaboration, technical excellence, and market transformation guides her to advance the Council's mission to scale sustainable building solutions, embed best practice, and foster a culture of environmental responsibility across South Africa's built environment. Georgina holds 2 master's degrees and joined the GBCSA after nearly 10 years of consultancy at Arup, where she contributed to multidisciplinary projects focused on resilient design and low-carbon innovation. I also want to add that Georgina insisted that I read every word of that bio. Moving on.
Welcome, thanks, Annalisa. Hi.
So welcome to my panelists. Let's start with you, Eileen. So Eileen, thanks once again for the presentation. Now, the results, clearly show that green certified prime and A grade offices outperform their uncertified counterparts across multiple dimensions of investment performance. SAPOA, that for the uninitiated, that is the South African Property Owners Association, indicates that one of the criteria for an office building to qualify as prime grade is that it should be 4-star green certified, or in the absence of a formal rating, include equivalent environmental initiatives, which could include zoned lighting, energy efficient building services and systems, water efficient fixtures, rainwater harvesting, water-wise landscaping, and low VOC interior finishes. Eileen, maybe just explain to the audience why the MSCI index only compares certified buildings and does not count buildings that have, let's say, certain environmental sustainability features but remain uncertified.
Thanks, Annalisa. I think for us, because we work in a world of absolutes, it is very important to have the certification on that building that tells us that this building is definitely green. Having a green criteria doesn't give us that absolute that we need. We believe that the green certification, we need some third independent body to come and tell us that this building is green, and we work on that. The results actually are quite interesting. We in France did a very similar exercise to what we do in South Africa, but there they initially chose to include certified buildings from BREEAM and whatever their local certifications are, as well as buildings that had green features, and the results were completely inconclusive. So if we compare those two studies, it actually does show us that using only certified buildings, and maybe certification doesn't necessarily need to be green building certification, although in the South African context it is that, we do come to a very clear and distinct set of results.
Okay, excellent. Thank you, Eileen. And speaking of the independent third party, let's talk to Georgina. So, Georgina, the index results themselves don't distinguish between different types or levels of green building certification. So it doesn't show you how investment performance for a 4-star green rated building may be different from that of a 6-star green rated building. So although most of the data, as I understand it, is comprised of buildings that have existing building performance ratings, the results don't necessarily draw a distinction between the different types of certification. But in your view, Georgina, is the type and level of certification likely to have a material impact on asset level performance?
Thanks for the question, Annalisa, and good morning to everybody on the call. So I think to answer the question in short, yes. There would definitely, and there can be a material impact on the asset performance, but it is definitely caveated and it's context specific. So as the GBCSA, our mandate is to get everybody started on the journey so that we can try and influence scale. And that really means that we need to consider what is that minimum requirement to get everybody started on the journey. What does that look like? And then how does that translate into an investment case? Because if people are not, if people don't see the value of taking that first step, we're not going to get, more followers on the road. So this study proves that, right? So it's about looking at the data to say, if you take that first step, you're not going to lose money. So, there are a lot of views about, green being super expensive and it's, not really going to have any financial case. But this is looking at data, to try and understand that. But obviously beyond that, we would love to have more data to prove the case for differentiation. Because obviously higher ratings, a 6-star, Green Star EVP rating could translate into stronger outcomes. So you could have better energy and water performance or sharper tenant appeal, but those outcomes are definitely going to be very context specific. And then I think the reality, and Eileen has already fleshed some of these items out, would be that things like location or the municipal taxes would outweigh the nuance of the difference between a 4, 5, and 6-star in some contexts. And I think specifically, this is where the value or the story of what a green building is defined for a lot of existing buildings in South Africa is important. You know, if we look at the Green Star EBP, Existing Building Performance Framework, it's a very holistic approach to sustainability. So yes, it looks at energy and water, but it looks at a lot of other elements. And that nuance would be specific either to a REIT kind of focus area or that facilities management team's priority. So that, you know, those kind of details, you know, need to be drawn out. And I think one of the challenges currently in our market is that we don't have an appreciation for the differences in certification. So the differences in performance levels within different types of rating tools is even less understood. And we are really trying to support better literacy within, you know, the stakeholder value chain beyond the green building consultants, you know, who do understand that detail and that nuance. Because obviously at the moment we're in a space, there are a lot of green claims, lots of ESG frameworks, different standards, and sometimes that can be a little bit, you know, a little bit overwhelming for kind of newcomers to the space. So really, it's about understanding what those shades of green are, and that would be including understanding the difference between a 4, 5, and 6-star, understanding what your scope is, you know, how many sustainability dimensions are you looking at, how far are you pushing the boundary past a benchmark? Are you going for net zero, or do you want to be better than, you know, your peers? So, you know, understanding that difference, and then importantly, looking at what that data means. So for a 5 and a 6-star, what is the nuance between the data points that you're getting back to verify the actual performance of that building? So definitely the star ratings can signal, you know, higher impact within the spectrum, but they do need to be understood within the context. And I don't think our data and our ability to collect that data is translating into any, you know, kind of investment cases as of yet. But in theory, it should.
All right, thanks, Georgina. And speaking of investment cases, Engelbert, let's ask you. You know, the results of the index indicate that green certified offices continue to earn a 34% higher gross income per square meter and a significantly lower operating cost to income ratio. I believe it was 41% versus 48% for non-certified offices. Now, it is best practice for investment committees to consider the sustainability performance of real estate assets when they are allocating capital. In your experience, have you started seeing these issues come up in board decision making? And in your opinion, you know, are deal makers taking them into account in any meaningful way?
Yeah, thank you very much, Annalisa. You know, if I have to respond to the question, I want to state I can only speak on behalf of Growthpoint at this point in time. And I think the second comment is, if you're talking offices, I think Eileen spent some time talking about the structural issues in that sector, which also had a huge overhang in terms of supply. So I think very little offices are being built at the moment, but we are seeing a lot of refurbishment going on. And you must also look at the different geographies. I think KZN is doing exceptionally well, and there's demand for office space as well as in Cape Town. And I think Eileen spent quite a bit of time when she was talking about the assessment rates in those particular areas, and I think eThekwini in particular has made it difficult. So from a Growthpoint perspective, the short answer, are we considering certifications? The answer is yes. I think we've gone public and stated that 100% of our long-term hold commercial assets will be a minimum of 4-star certified. And we have a team working very hard at getting that done. And when I say long-term hold, by implication, I'm saying there's a lot of properties that we don't want anymore, and we are disposing of them. And these properties, we believe, you know, will detract from a value perspective over the long term. So definitely that decision is being made, not just in offices, but we've seen it in industrial as well. I think we certified one industrial property the other day. I think it was a 5-star that we achieved. So certainly there's a discussion. It's always a discussion point. But I think it goes further than that, because I think when you start looking at ESG and you're going to market and you're publishing, all the wonderful things that you're doing, it's become a KPI for executive management. And it's also become a KPI from a REM point of view. So I think our board is, taking it seriously. These factors are included, and we are being measured accordingly. So after all of that, the simple answer is if you're not taking the data into account, and it's proven data now, as Alina said, over a 10-year period, and you're not incorporating that in your decision making, I certainly think you're falling behind.
100%. Thanks, Engelbert. Eileen, the survey has expanded to include retail assets and to an extent industrial assets, which show some promising results. But every year, and we've already got 2 questions that were submitted beforehand on this, every year people ask when the study will incorporate data about residential assets. So is there any information regarding the total returns for uncertified residential assets? And is there enough data at present to compare certified to uncertified residential assets as well?
Thanks, Annalisa. Residential is a sticky one for us. We would love to cover a much broader percentage of the market. MSCI started looking at residential data because residential is not typically seen as commercial or investment properties. And that's what we look at. And typically residential didn't fall within that remit. So just to give you a little bit of history, we did since 2017 start bringing that in, and very much when we think about residential, we measuring residential, we're looking at multifamily housing that is for letting purposes. So we don't think about residential, the house that you or I buy to live in, as part of our remit. It would just be properties that are let out that have a rental income would fall within the MSCI world. Okay, so already we've taken out a proportion of assets that we can then measure. Okay. The second thing that is a blocker in the market for us at the moment is valuations. For us to be able to include assets into our sample, they have to have an external valuation within their either annual or biannual, or at least an annual kind of external valuation. And the residential market from that perspective is quite, I want to call them immature, and I don't mean that in a bad way at all. I just mean that it isn't being institutionalized in the same way that we have done offices and retail, the traditional sectors, meaning that it is not necessarily, properties are not valued because they're owned very often by developers or by private owners. And there isn't necessarily a need to have that external valuation. So they're not held within REIT structures or insurance companies as much as what they are in the hands of private. So for us, and it's not because they're not being certified, it's because they're not treated necessarily as investment assets in the same way as the traditional sectors. There is a big movement. We have got SAMRA, which is the South African Multifamily Residential Association, that is very much driving an institutionalization of residential assets in the market. And so we are seeing a lot of capital starting to chase those assets. So I do think this is going to be a very different space in 10 years' time. So the issue here doesn't lie necessarily with certification. It is within the institutionalization of residential as an investment asset class, rather, if that makes sense. But we're on track. We're getting there.
Okay. No, that's very promising. Thank you, Eileen. Georgina, the MSCI index, makes the business case for green certified commercial buildings quite clear. But I mean, as Engelbert and Eileen have also alluded, the take-up when it comes to certifications is still relatively market-driven. And so you're definitely seeing probably an uneven spread, with the offices primarily having the bulk of certifications, followed by sort of retail and industrial. But my understanding is that the GBCSA has entered into a partnership with the World Green Building Council to develop a building sector roadmap for Gauteng. Could you just give us a 2-minute summary of how that roadmap will help scale the adoption of green and sustainable building management practices?
Yes, certainly. We're very excited about the project. It's being led by Bakang, who's on the call today as well. And just a quick summary, we successfully secured funding from the World Green Building Council, and it's to develop a decarbonisation and resilience roadmap with the Gauteng province. So in effect, we would be a strategic partner in advancing provincial climate action and low carbon development. So the budget's been approved. We've had Bakang's had some initial engagements, both with the Gauteng Department of Environment and also our technical partner, the CSIR. And, the project has been positively received by both stakeholders. It's going to be over 24 months, so over the next 2 years. And we really feel that it's exciting because Gauteng is, as we all know, the economic hub of South Africa, but is also responsible for a large portion of our carbon emissions. And really, what is, the project's about working as a strategic partner with the province to identify proper actions that we can take and that can be implemented, that are realistic, that would look at decarbonisation across some key sectors, and obviously the built environment would be one of those. So we're very excited by the opportunity to inform and support a broader strategy based on our experience from the last 15 to 20 years in terms of driving change and working with industry, working with the property sector, understanding what works and also what doesn't work, and being able to support climate action in a way that actually moves the whole industry forward. So definitely watch this space. I think it's going to be a fun project, and we'll definitely support uptake down the line.
Okay. Excellent. Thank you, Georgina. And it'll be interesting to see whether that project comes with some generous incentives from the Gauteng provincial government for people like Engelbert. But Engelbert, back to you. The P&A grade segment of the office market is fiercely competitive, especially given the continuous oversupply of office space that you alluded to earlier. And tenants want flexible offerings that offer energy and water backup installations, access to amenities, and environmental resilience. So within this context, what benefit do you see from the market adopting a single or perhaps consistent standard of what constitutes a green building that's not just concentrated on one or two very binary metrics, in your view?
I think it's a great question, Annelies. I think a lot of it's got to do with marketing, and you can do a lot of tongue-in-cheek marketing about the values that you have in a particular property, what amenities they have, and then you sell it as so-called green. To my mind, I think it would be great if we had a single source of truth, and by implication, I'm saying that should be anchored by certification by GBCSA, and then you can compare asset like for like. I think what we're doing at the moment is a lot of greenwashing that's going on. Claims are being made, and I don't think that's consistent. So I think if you can have an accreditation model that is consistent across all portfolios and from a reporting perspective, I think it will give it a lot more credence, and then you can inform and educate your potential users in the market. Some of them have really latched on, and we've got corporates that came to us and say, well, they want space, but it has to be a green certified 6-star GBCSA building, and then we can accommodate that. So slowly but surely, the tenants or our clients are starting to catch up. I want to take it one step further, and in preparation, for this discussion today, I went to our corporate affairs department and I said, "Can you tell me on how many sustainability indexes we are?" And I was amazed. So please allow me 1 second. Sustainalytics, okay? They review our ESG report, okay? FTSE for good. It's an assessment done based on public information. GRESB, we do a survey. CDP, there's a survey. S&P Global, there's a survey. Morgan Stanley Capital International, ESG public information. So what you're putting out there is what's including you in indexes. And I think if we could have consistency, I think then it would be, I would almost say it'd be a fairer inclusion or not from these indexes, in my opinion.
Yeah, 100%. And maybe for the people on the call as well, these indices tend to be quite specific that if a listed entity does not achieve a certain level of sustainability performance, it cannot be included. Whereas if it does actually achieve that level, it then gets included. And prime example of that would be, FTSE for Good. So it definitely does provide a lot of benefits. But as you say, Engelbert, there is a lot of greenwashing, right? And at the moment, all someone has to do is go up to a landlord and say, "Is this building green?" And they're like, "Yes," with no further substantiation. So we definitely need to definitely standardize things a bit more.
Anecdotally, they point out to the water tank, and there's solar on the roof, and there's backup water. You're good to go, but I think you're missing the point entirely. And I think that's what's done. Standardization would be great.
Yeah, fully agreed. But we're going to trigger Georgina if we keep talking about some of these anecdotes. So let's get to Q&A. So audience Q&A, we've received a couple of questions online. I want to deal with Saul's question. And I'm going to get this to you, Eileen. So Saul asked, capitalization rates are lower for green buildings. Is the difference in capital growth also underpinned by modified discount rates for green certified buildings from valuers? And Eileen has now run away. But while that's happening, we've also got a second question, also from Saul. In the current market, and I don't know, Engelbert, if you also want to weigh in on this, does the brown discount... Okay, Eileen is back. Eileen, you're back with us?
But
Hi, guys. I'm sorry. I'm back and I'm not back. Please just give me 2 minutes. Excuse me for 2 minutes, and then I will rejoin.
No problem.
Apologies.
All right. So, no problem. So, Engelbert, the second question from Saul, in the current market, does the brown discount have a heavier impact than the green premium for landlords or investors when assessing potential acquisitions?
I think the simple answer is no. I think, the brown discount, you've got people that play in that particular space, and there are people in the green premium that play in that space. I think the different listed companies all have a different investment strategy, and they play in different spaces. So even non-certified properties, every property has a price, and people play in a different space there. I think it's a conscious decision that a landlord would take in terms of investing in green premium for long term, or do you want that immediate income return from the non-certified space that is currently, it certainly happened over the last 12 months, but I think it's an anomaly, and it certainly won't continue in the future.
Yeah, truly noted. Yeah, and I think, as you say, the particular company would need to make a very conscious decision and would probably need some sort of checklist that the investment committee would consider alongside the other information that would be included in a due diligence for a potential acquisition. And Saul, most of the market is nowhere near that. Hopefully they will get there in the next few years, but at the moment it's very much, on a company by company basis. Eileen, are you sorted out?
I am. Thank you very much. I wanted to just add one thing, sorry, and I didn't catch all of that. But something that companies are starting to think about, because it's something that we are dealing with more often, is doing a climate risk assessment in that due diligence process. Yeah. So actually being able to understand, are there any physical risk exposures to the building, and what might the transition risk look like? And so that would talk to your brown discount or green premium, but it does affect then the price that your buyer is willing to pay. And we've actually seen cases on that in South Africa in the last sort of 12 months where buildings were in the process of being, the acquisition was going through. There was a risk event on that building, and the questions were asked around, was there a climate due diligence done on the building prior to acquisition? So I think that is going to become more prevalent in the market.
Yeah.
Maybe, Annalisa, just to add,
Yes.
kind of going forward, for those on the call who might not be aware, in terms of looking at the new Green Star standard for new construction, one of the requirements is that you have to do a risk assessment. And it's been done really well. It's available. If anybody wants to have a look, you can test it out on buildings and play around with it if you want. It's based on local data, but for that reason, it's around conveying information and actually communicating that risk to a client. So obviously part of the question is around whether or not, once you know that risk, then translates into a better or a worse sale price. And my understanding is also that we don't have enough transaction data actually to link that and actually make a strong argument. And we have looked for a lot of that data overseas through other green building councils, but there's not a consistent story with some of the data coming through. So we're seeing examples of a premium and a discount, but not a consistent story across the board.
Okay, noted. Thank you. And just want to encourage everyone on the call to please put questions in the chat function, and I will shoot them to the panelists. We did get a question earlier, and Eileen, you were just sorting yourself out, but I'm going to ask it again. So this is from Saul, where he asked whether cap rates are lower for green buildings. Is the difference in capital growth also underpinned by modified discount rates for green certified buildings from valuers?
So yes, so generally, when we collect the data, and we go back one step, we will collect a cap rate and a discount rate. We tend to talk to the cap rates as the indication of risk, but just equally, we could look at discount rates as well, and they tell a similar kind of story in effectively an assessment in what you're going to discount the value at over a period of time. So you're going to see, yeah, it tells us the same picture.
Okay, noted. And we got a question from Sibusiso earlier. He actually asked it before the webinar, and I'm going to give it to Engelbert and Georgina. The question was, how do we practically translate these discussions into everyday problem-solving solutions for the townships and neglected rural areas? And Engelbert, it'd be interesting to hear your view on this, given that there's quite a bit of talk at the moment around the growth in investment in township retail specifically. So in your view, how do we actually kind of take some of these results into those kinds of areas?
Sure, it's quite a tough question to answer. I'll give it a stab. Maybe just the caveat is that we don't have any township retail or decentralized retail. That's, once again, it's that our particular strategy. But I think the companies that have invested in township retail have done exceptionally well. I think if you just look at the results that have come through, have they considered what needs to be done? Well, I think if you're a listed company, if you're a REIT, then obviously you have to comply with certain obligations, one being a risk committee, and there's certain values associated with that. And I think you're obviously going to be reporting from an ESG perspective. And we spend a lot of time talking about the S, in terms of that. Sorry, I'm on the E, environmental, sorry, my apologies. Whereas the S, it really talks about social and the impact that do you have on communities in and around, where your assets are, and, to what extent you're contributing to that. So even as Growth Point, we have certain properties close to industrial areas that are associated next to a residential area. We've had one instance where this particular area is rife with gang warfare. And, we've had to create a safe haven for a lot of people and create a space. And you can't always put that into a certification, but it's something certainly you can report on from an S point of view.
I think, Annalisa, also just to add, I would argue that a lot of the green building principles and the risk and the resilience outcomes that you're seeing within these results could definitely be translated into different contexts. I mean, they would obviously have to be adapted, for the specific context and the specific location. But in principle, looking at things like ensuring your energy and your water supply has been, well reviewed, and looking at how your building has got dual functionality, which would be a more holistic way to approaching your building design that is captured in, the Green Star framework. That would work very well in a rural context. How does a mall or a shopping center also, function as a community need during different times of the year? So I definitely think that there are many principles that can be translated. I think it's probably more a question of what is the appropriate mechanism relative to the scale and the delivery that is going to add value. That we probably need to discuss in more detail and collaborate on. And I see your comment in the chat around retrofits. We are very passionate about retrofits in the green building space. It's really looking at existing buildings and seeing how we can think about adaptive reuse instead of, rebuilding new things. So retrofits are a big part of the green agenda, and definitely a big part of decarbonization plans and strategies going forward. So typically that would be recognized within the existing scheme, either from a local sourcing perspective or from a materiality perspective, but there are ways that it could be captured. And then I think also potentially a area for exploration and future partnership is maybe just around sector development and training, and seeing where we can support in that regard.
Okay, great. Guys, the chat function is looking a little bit dry. Please do shoot through any questions or comments. While we're waiting, I want to just take a question that was also submitted ahead of time from Michael, who asked, the most common question is, what is the ROI on the retrofit of an office block that follows the EDGE standard? And I'm going to ask Georgina to take a first stab at this, but Engelbert, Eileen, please feel free to jump in as well.
So in terms of a major retrofit, the ROI, whether it's EDGE or whether it's Green Star, that would be a pretty easy, I mean, it would be simple enough to equate, because you would look at your CapEx expenditure and then understand what the proposed saving is with time. And then you would obviously also look at the total return and these kind of stats. If that then renders the building certified and you've looked at a broader range of sustainability features. So I think to answer your question for your specific building, it's where is your ROI direct? So it's, saving energy or it's saving water, versus where is your retrofit an adaptive benefit for the future. So going back to those slides that Eileen showed, and whether it's EDGE or whether it's Green Star, you need to, so the slides that showed the non-certified offices that, for example, had 36% of their value eroded versus the certified offices that I think were sitting at about 30%. Is your retrofit spend in anticipation of future climate change? Are you spending on the climate risk that you're anticipating, and where you think value is going to be eroded within your asset value within the future? So are you thinking about how is your building going to deal with those more hot days that are coming? How's your building design? How's your HVAC system dealing with that? So, you would have to look at where your retrofit is focusing on supply and security issues versus preventing future loss because of the impact of climate change. And I would argue that that is would be true for any rating, and then you would have to think about what the scope of that rating includes. Is it just looking at supply, or is it also looking at climate risk? Because I think your ROI would obviously be better if it's also looking at climate risk and not just at energy and water supply.
Quite right. And I mean, speaking anecdotally, I think you're probably seeing quite a few asset owners, installing water backups or energy backups in response to tenant requirements, and not necessarily in response to climate resilience needs, which would require them to look a little bit further into the future. So I'm still waiting for my participants on the call. Please go for it, Engelbert.
Lisa, sorry, I just want to add, I think it's a great question. And I think, Georgina's talked about climate risk and future looking. I think as a real estate owner, you assess, a retrofit, and it becomes a mathematical calculation. It's as simple as that. But I think there's some soft issues that come through with a building that is accredited and sustainable and future looking, because it creates a bit of a stickiness for your client in the building. And I almost want to challenge the MSCI. It would be very interesting to see to what extent clients renew their lease in certified properties as opposed to non-certified properties. I think, the office space today, people can shop around. There's a lot of incentives. But I generally feel it's become a corporate decision, and it creates a stickiness. So you won't see it immediately in your mathematical calculation, but over a period of 10 years, you will certainly see that number come through.
Yeah, agreed.
And I just add, I think we see that actually very clearly coming through in the numbers, and that vacancy number and your rental renewals or your rental growth numbers over time are higher. So, Georgina spoke to the return on investment from a climate perspective, but just purely from a financial perspective, the data shows that over a period of time, you are getting a better return on that investment, be that through the stickiness or the rental rates or whatever it is, through the cycle or through the next, whatever cycle you're going into in that. So you're future-proofing the office or the rental of the office. No way.
All right, so I've got two questions that have come through in the chat. One is from Saul. Is lease renewal impacted by IEQ for an office building? I'm going to ask Georgina, Eileen, and Engelbert. Do any of you want to take this one?
So I think probably Engelbert and Eileen are best positioned to answer it. I mean, we would like to say yes, but it's whether or not the market is actually seeing the value. And so maybe just to let everybody know on the call, if it does sound like Greek, IEQs, indoor environmental quality, which means how are you thinking about making that space more comfortable? So good fresh air, good levels of natural daylight coming in. Do you have access to external views? Have you thought about, the temperature inside? Often there's an energy impact when you're making it more comfortable for the users inside the building. There's typically a resource impact. So there's a trade-off often. So ideally, yes, and there are studies that have indicated, and I have always maintained that I think because the profile in MSCI actually speaks to Green Star EBP, and Green Star as a framework doesn't just look at energy and water, it looks at a very holistic approach to sustainability. There is also that element, because that IEQ translates into quality of space, which then translates into tenancies. So that's our theoretical approach to answering the question, but I'll hand over to Engelbert and to Eileen.
Well, I think that it might not be explicit, but it is implicit in the data. As Georgina said, the certification deals with all of those characteristics of the building. And so it's implicit in the fact that you're going to see seeing lower vacancy rates because of a green rating on the building. And that may be one of the factors underlying that. The implicit is the IEQ of the building itself. Although it's very hard to draw that out, in a very empirical way, unless you did maybe a survey of the tenants themselves and asked them the reasons. And there are studies like that, as Georgina said.
Yeah.
Certainly from my side, the answer is yes. And I think we all occupy office space, and the smallest change in HVAC, or if something doesn't work, or it's not appealing space, then you get disgruntled and it's not a great place to work at. So yeah, it's including the certification, but it's a touchy-feely effect, but I think it has got a long-term impact on your occupancy.
Yeah, 100%. And I think the days of sort of saying, listen, we don't really have to pay much attention to your comfort as landlords, I think those days are in the past. And Georgina, please do forgive me, but I'm just going to also mention that Standard Bank, I believe, has got well building certifications on its owned and operated offices. I believe the rationale there is specifically to focus on the health and well-being of their staff members as well. All right, so I've got two more questions. Sibusiso has got a question for you, Georgina. I think he's talking about his business. We have a 1 million light bulb retrofit and energy efficiency project in the townships. How do we develop a framework to ensure that those properties can be measurable and the Baki contractors in the space have a certification as part of skills development? And then I've got a second question from Marianne. Year on year, as the data has become clearer that green building is in fact more profitable, do you feel there has been a strong shift in awareness and acceptance of this, or is the market itself still lagging? Is it still a case of only a few pioneering corporates who see the value and are prioritizing sustainability initiatives? I think for the Marianne's question, I'd like Engelbert to take that one, followed by Georgina and Eileen. But Georgina, maybe quickly talk to Sibusiso's question here.
Yes, thank you. And thanks, Sibusiso. I mean, firstly, well done. I mean, that's a big retrofit project that you've got on your hands, and that sounds amazing. In terms of partnering and collaborating, I mean, we would really have to discuss some of the detail, but I think it's around finding a solution in which your inputs as retrofits are tagged. So, how are you highlighted as a contractor and a service provider who could implement energy efficient lighting? So obviously at the moment we've got our green pages, which is where we showcase our members and either through products or services, we then position different members according to different impact areas. So if you're dealing with energy efficiency, it would be around the energy category, or maybe you're dealing with water. So I think let's have an initial chat and understand if that potentially could add any value, and then we can also set up some time to take the conversation further. It seems like you're doing amazing work.
Excellent. Engelbert, you want to talk about Marianne's question of whether there is a strong shift in awareness around green buildings? Do you feel that the market is still lagging? Is it still a case of only a few pioneering corporates that are steering the value? Obviously, Growthpoint is one of said pioneering corporates in this case.
Thank you very much. But I think there are others, and I think, without mentioning them, I think we've got a couple of people in that space. It's a little bit like a bull in a china shop, and it's just, and I'm talking about a residential developer in this particular instance that's been onboarded. I think there's too few people certifying, but when you look at the history of the GBCSA certifications, and maybe Georgina, you can mention some of those, but you've actually seen exponential growth in certifications over the years. And I think it's an awareness that has grown. You can just look at the GBCSA's conference and how the number of attendees have grown over the year. Everybody is in the sustainability space at the moment. We've seen what's happening around us. I mean, some of the devastating floods and issues that South Africa's been hit has caused massive damage on infrastructure and take years to be remedied. People are aware of climate, global warming, and as such, I think every responsible corporate should be embarking on this journey. It's not if it's going to happen, it's a question of when it's going to happen. And I think slowly but surely we'll get more take-up. For now, there's a handful that are participating. I would love to see the Department of Public Works on board, so the government shows the intent. I know discussions have been taking place there. Maybe, Georgina, you can just elaborate on that. But yeah, we're riding a wave now, and we need to stay on top of this surfboard, because I think it will be great.
I would echo Engelbert's sentiments. I think, yes, we have some great leaders and newcomers to the space, and we have definitely seen exponential growth within the collective green building community, both either through the metrics that the GBCSA publishes to the market, but obviously there's a big stakeholder chain that supports those metrics. But I mean, when you look at the results, you look at the data, you look at the study, I do often wonder why we do not have more REITs and more listed corporates and more major funds certifying. I think that there is still a lot of room for growth, and fundamentally every building should be on a sustainability journey. We've got products to support any point in a building sustainability journey at very low cost. So there's actually no excuse for any building owner. And that is where we definitely would like to drive change and support development within the sector going forward.
Okay, no, 100%. Guys, we're moving on to closing remarks. Eileen, I'm going to start with you. Give us your 1 minute mic drop.
Okay, so I think just to conclude on the results, the key takeaway is that the certifications across the offices and starting to show in the retail is that returns on those certified properties are more resilient than in the non-certified. And if we start measuring climate risk through certification as that rubber stamp, we're starting to see metrics like transition risk also be lower on certified buildings. So that certification does matter. It does reduce risk over long periods of time, both income risk or financial risk as well as climate risk. And the evidence is clear.
100%. Engelbert?
Yeah, thanks, Annalisa. Climate risk is real. Every time I go to a risk committee meeting and we look at the probability of, or what the impact of climate risk can be, I can see it moving up the ladder. And at the moment, we're looking at geopolitics and the likes, but there's not a big difference there. And then to MSCI, thank you very much. I think 10 years ago, we thought we had the answer. I think 10 years down the line, the data has proven itself, and for those early adopters, I think they'll see the benefits, just go in future. And then to everybody on the panel, please be an ambassador for the GBCSA. Let's get those certifications in, and looking forward to have a drink with you at the conference.
I'm going to take you up on that, Engelbert. Thank you. Georgina, over to you.
Thank you, Annalisa, and thank you so much to Eileen for really an amazing presentation with a lot of content, and to Engelbert and Annalisa for contributing to the panel so well. I mean, this is such an interesting topic. My closing message is we have local primary data that shows how green building certification does not have to be a cost. It can actually be a competitive advantage. Please amplify this message, share it with your networks, and we are here to engage. Obviously, the specifics and the context count, but we've got great local research. Let's use it and let's spread the message of green. Thank you.
Excellent. And since I am the facilitator, I get to have the last word by default. Thank you so much to the panelists. Thank you to everyone who's dialed in. I mean, the results are always a point of interest in the market. Let's spread the word, as my fellow panelists have said. And I just want to almost leave you with this. The market is increasingly accepting a certified building as the norm, certainly a certified commercial building. And I do see that the market is starting to gravitate towards seeing a 4-star green rating as an acceptable level of environmental and social performance. So as much as, we aren't necessarily seeing a consistent standard throughout, I do think the market standard is slowly starting to converge at that point. And I think as the market evolves, we will probably start seeing more buildings start getting penalized for not having a certification, which then moves us closer into the so-called brown discount territory. So now is definitely the time to adapt while there's still an opportunity to earn a market premium. Guys, thank you so much. Thank you, Eileen, Georgina, and Engelbert. I hope you all found the session informative. Just a reminder that the 2026 Green Building Convention is taking place on the 27th to the 29th of October 2026 at the Century City Conference Center, and we hope to see you all there. Please feel free to reach out to the GBCSA team regarding attendance, exhibition, or sponsorship opportunities. And of course, if any of you have got any questions or any comments that were not addressed in the webinar, please do reach out to the GBCSA team, and any one of the panelists will address it. But otherwise, please do have an amazing day. Share the message on the socials, okay? Use your LinkedIn profiles to good effect. And let's get the message out there, because this is, as much as this was the launch, the purpose of this index is really to prompt a discussion and to start moving the market towards certification. So please, I encourage you to continue engaging, and we will see you soon. Thank you very much, everyone.
Thanks, everybody.
Thank you. Thank you.
Thanks, everyone.